Well, yes, the city gas distribution space is abuzz, and this time not for the best reason. So let's break it down and tell you what is exactly happening in the space. The three companies, be it IGL, MGL and Gujarat Gas, all three of them have cut prices. IGL and MGL, they've done it for their CNG segments, and Gujarat Gas has done it for the industrial segment. And all of them have cited lower natural gas or their raw material prices going down for this price cut. But price cuts are usual course of business. So why did the stocks fall so much? Well, this is because at the same time, Oil Minister in a press conference said that gas sector reforms, they have not reached the end consumers at a time when government is focusing on affordable gas prices, and added that they are worried about high profits earned by these companies, and the government is ready to take steps with respect to pricing and ensure compliance by these companies as well. That is not it. The PNGRB yesterday also uploaded a document that indicated that Mahanagar Gas's exclusivity in Mumbai region ended in 2021. That means they will not have exclusive rights to this region when it comes to CNG sales, which could impact their volumes. Now, before we look at this impact, let's try and understand what kind of margins these companies are making. In Q3, MGL made the highest margins at 13.3 rupees per SCM, followed by IGL at 7 rupees and then Gujarat Gas at 4.8 rupees. Of course, MGL and IGL, they have highest exposure to CNG space, and these have direct impact on retail consumers. Now, in terms of profits, IGL profit margins, they've been between 15 to 16% in last 4 years, and 19 to 20% is for MGL. This is just in last 2 years. Now, what got the street worried in that case? One, they are worried about government's intervention with respect to pricing in the CGD sector, which has been market-driven so far. And second, the exclusivity issues for some of these companies, which could end soon, leading to more competition and less volumes. So there would be a hit on both margins and volumes as well. Now, we spoke to the PNGRB, the regulator that is, and they indicated that they received no communication from ministry regarding curbing CGD pricing, and there's no intention to intervene or regulating or getting into the day-to-day activities as well. They are in favor of market freedom. Profit level is 20% in CGD infrastructure, and they're not saying CGDs are making any supernormal profits, but ideally they should make 12 to 15% profit margin, which is reasonable according to them. But right now these companies are making profits which are 20% higher than the current levels. Now, this is what the street is worried about. Lot of commentary, and that is something that the street is watching out for. But what next? First, the end of exclusivity for CGD companies is still sub judice, and there's no final decision awaited on this. This can extend by 10 plus years given precedence and could happen for MGL as well. Second, regulating profits for CGDs would mean lower capex in the sector, and this would be a conflict with government's goal of expanding gas economy and infrastructure as well. So, what are the brokerages making of this? MK, for instance, says such comments closer to elections are expected given that petrol and diesel price cuts are also long awaited. However, pricing freedom should endure and stay linked to market forces, and nothing has really changed for this sector. Nuvama says more than half the price cut by MGL is led by easing spot prices, and hence they are still more popular or more competitive than petrol and diesel prices, and hence volume boost is likely. The PNGRB stated MGL's Mumbai monopoly ended in April, but nothing can move forward till pending court cases are resolved. ICICI Securities says that technically the PNGRB cannot allow for regulation of end consumer prices, and the signals that they are getting from the pronouncements may indicate further lowering of priority gas allocation to CGDs. This could impact their margins. For CGDs, they are also puzzled that there is a need by the regulator to increase penetration, and at the same time they are talking about lower profits as well. And this is what the street is worried about. There are mixed signals that they are getting, and there could be further price cuts as well, and that could continue pressure on these companies. So it is an important space, and we have to track that closely.